it is great to see you here at 731 Lexington, back in New York City, traveling. Thanks for coming.
Well, thanks for having me. It's been over a year and a half since I was back in the city.
Amazing, isn't it?
Yeah.
You're based in Dallas. That's important for people to know. You've also been active in fixed income for more than 30 years. You were behind the first CLO back in 1996. How frothy is the credit market right now?
Well, everything's frothy, right? This wall of liquidity is affecting everything. I would say as we look across all fixed income, all credit asset classes, there is no shortage of money. I was talking to a dealer this week, and we got the quote is, there's an infinite amount of liquidity a quarter back. So that means that the money's there. But on the other hand, there are parts of the market that are more irrational. And one of the areas that we were just talking about is floating rate credit. And we like that.
The loan market.
Yeah, the loan market, the securitization of the loan market, which is what CLOs are. That market is much more rational.
Relative to the bond market.
Absolutely, absolutely.
Just to be clear, you're saying that in terms of valuations,
Sure.
frothiness, the bond market is, in your eyes, more overpriced than the loan market.
Take high yield bonds, right? You got high yield loans, high yield bonds. High yield bonds are at 300 over. The year ahead look is probably to stay at spread maybe, but you're pricing out the 5 or 7 year. And if the curve steepens the way it has been and probably will be, you make no money there. That's not a great value opportunity. Loans have beat the ag by 600 basis points already, and we still haven't seen rates move.
Mark, there are so many lively debates about the economy right now, whether
Right.
we're heading into an inflationary cycle, how long the supply chain squeeze is going to last. What is your loan portfolio telling you about the economy, about those things, and also about hidden strengths and weaknesses?
Sure. I would say it's, instead of stagflation, it's a dragflation. We've seen a lot of drag on the corporate execution coming out of the pandemic. Companies are dealing with a lot of supply issues. This is pretty obvious to everyone on your programs, and I think in the market. But on the other hand, demand is there. Demand is there for top line. So the question now really is, how is this endemic like COVID, or is this something that is transitory and will go away?
Answer the question.
I'm in that it is much more long lasting, but on the other hand, I don't think that demand dissipates either. I'm not in the camp where prices rise to the point where we kill demand, or the Fed makes a mistake. I think the Fed will be very late here. I do think that the Fed will not raise rates next year. But even if they did,
If they said they're going to, you think they're going to chicken out?
I don't think that they are in this place where changing the game as far as negative real rates actually gets them anywhere. It doesn't help with supply. It doesn't change the problem. So that's that answer, that historical answer where demand is always the thing that we're trying to stimulate, is not the case. So that's not going to happen. So we're calling for a longer cycle, a longer economic expansion is going to be lower, and we're going to be dealing with higher prices. The reality, though, as far as markets are concerned, markets have figured this out pretty much. I mean, look at the strength that we're seeing, all the things we were talking about. You haven't had a moment really in the credit markets where it said, okay, game over, right? There are no defaults. There's very little stress. Everything's priced to perfection, but that's not going to change per se. I think that stays the case, unless there's only one scenario where I get a little worried at this point, and that's the technicals, right? If you look at what the story from this year on the rate environment is, the 10 years kind of ignored everything, and it's kind of just sat there. And the reason it's ignored everything is technicals. The Fed's been buying everything up, and there was a point there, actually, Eric, where they bought every bond. They were the whole market, because the net supply was negative, was shrinking. So we're past the debt ceiling, and demand's growing, and supply is starting to grow, and they're going to taper. So could we get a 200 basis point 2 to 10-year spread? Yeah, it could happen. That would, I think, put a little bit more fear in the greed, pond. But I don't know. I mean, we'll see. We'll see if that happens.
Mark, it's Alex here. It's really good to see you in the building. 200 basis point jump in that spread would be quite significant. And I'm wondering, where would we see the effect of that? Where would the froth shake out the fastest? And what would you be selling kind of into that fear?
Well, like I said, I'm not afraid of inflation because I'm prepared. So everything we're doing is floating rate. That's not going to hurt us per se because this is happening in a strong economy. That's going to crush anybody who's got some duration. And it'll be interesting to see how that comes. And duration today is not just bonds. I mean, you've got a lot of long duration growth equities that will probably struggle, Alex.
Yeah,
Mark.
and just to follow up on that in terms of then the CLO market, it's been so hot. Bloomberg has reported that you're going to be marketing one. How's that going? Can you give us some details of that, particularly in this environment?
Well, I'm not going to talk about specifics, but Alex, but look, we're coming up on our first year of the new firm, but this is not our first rodeo. It is amazing to see how big the world has gotten. In COVID, what happened was our competitors that were big got bigger. And now they're at this point where the ability to create alpha is very challenged. You're the market. You're so big, you're the market. So we can come in here and figure out what we think the best risk return is, and that's what we're talking about, and that's what we're going to do. And we're being selective, and it's actually kind of nice being small and starting up. But we'll see where that goes. I'm very, very constructive on what we're doing in the markets that we're doing, but we have the luxury of being able to do that.
Mark, what we've been talking about is the beauty of supply and demand and how it creates price discovery in the capital market. You're based in Dallas.
Yes.
You've been there since 1994. You were early. As you probably know, Texas has passed a law punishing banks, right, for limiting their business with gun manufacturers. And it's blocking J.P. Morgan, and it's blocking Citi and B of A and Goldman and others from underwriting muni bonds. And I want to ask you a philosophical question. Can we have a real capital market if governments make political decisions about who can and who can't participate?
Wow. I do think that political uncertainty and the environment that we're in is one of those drags that we were talking about earlier. I'm not going to get into that specifically, but I will tell you.
Doesn't affect you from what I...
No, it doesn't. I would tell you that where we do business and why we do business there is something that people will put into their calculus as to why they do what they do, where they do it, and they will adjust. You see people moving into Texas for a reason, because the capital is treated better there. The people are treated better there. We're just opening up our New York office. This is a great town. You need to be here for various reasons. So there's this need to position yourself and your capital and your business in a way that makes sense. Now, there are certainly a lot of things going on in the broader macro discussion that may give you pause about some of this, or may limit your ability to actually execute on those decisions. And that will be just more sand in the gears. However, I am very, very convinced that we will get to this place where this idea that things are more endemic or more long-lasting as far as factors, and you adjust to them, and then you move forward. So some of these
well, hang on a second.
Yeah.
You're not telling? Surely you're not telling me you want politics to be one of these factors.
They're going to continue to be. We've had so much political volatility. If you just look at a graph of how the people are coming out, look what's going to happen in the midterms. We're going to have 50 seats or something. It's going to flip the other way. This volatility continues. And that is just a reality of the way we all have to sit and look at risk and look at markets. and then do something about it. And I think that that's an opportunity, really, versus maybe something to get too worried about. So I think that's an opportunity. I'd love to see a little more volatility in general. It's really been interesting to see how we've got a little bit of it, and then it kind of peters out. Some more of that'd be good.